Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Vivakor Inc. annual report. Vivakor Inc. offers a diverse range of services and products in the oil and gas industry. At the core of their operations are trucking logistics services, which include transporting crude oil and produced water through their Omega gathering pipeline. They also provide terminaling and storage services for crude oil and natural gas liquids. In addition to these primary services, Vivakor offers environmental solutions and remediation services for properties contaminated with heavy crude oil and other hydrocarbon-based substances. This involves extracting hydrocarbons from affected areas, making it possible to restore the land to its original state. The company also engages in the sale of petroleum commodities, including crude oil, natural gas liquids, and related hydrocarbons. Furthermore, they operate terminaling facilities for crude oil and provide gathering and storage services for natural gas liquids. Overall, Vivakor's business model encompasses a wide range of activities within the oil and gas industry, from logistics and transportation to environmental remediation and commodity sales. Vivakor Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $98 billion. Vivakor Inc. trades at a lower price-to-book ratio of 0.01 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for the company can be attributed to several key factors. On the growth side, acquisitions have played a significant role, with notable purchases in 2022 and 2024 contributing to increased revenue. Organic growth has also been driven by the development of remediation processing centers, RPCS, and expansion of transportation services into new regions. Contractual agreements have provided a stable source of revenue, including long-term contracts with minimum volume commitments and take-or-pay arrangements. The remediation segment has emerged as a significant driver of growth through RPC commissioning and additional domestic waste treatment initiatives. Furthermore, the crude oil transportation segment has contributed to revenue growth through diversified assets and facilities. On the decline side, related party tank storage revenue has decreased by 34%, while crude oil purchases from WC Crude have dropped by 89%. Related party sales to WC Crude have also seen a significant decrease of 94%. These factors highlight the importance of diversification and contractual agreements in maintaining revenue stability. Net income and profit margins underwent significant changes over the period. Initially, net income was historically negative with an accumulated deficit of $99 million as of December 31, 2024, page 17. However, a notable improvement occurred in 2025 when the company reported a gain of $11,058,235 USD from the sale of subsidiaries, page 36. Although net income is not explicitly stated on this page, it can be inferred that there was an increase. Profit margins also experienced fluctuations. On page 16, it is mentioned that profit margins were expected to be negatively affected due to various factors such as delays and regulatory challenges. However, by page 37, the company reported improved gross margin in 2025 due to a shift towards higher margin transportation and logistics activities, page 37. In contrast, operating expenses as a percentage of revenue increased from an unspecified percentage in 2024 to 97% in 2025. The improvement in profit margins can be attributed to the company's strategic shift towards higher margin activities. Additionally, the strong gross margins reported by transportation and logistics operations on page 40 contributed to the overall increase in profit margins. However, a decrease in profit margins was observed on page 44 due to inflationary pressures. Based on the extracted summaries, it appears that the company is struggling to generate positive operating cash flow. The majority of the information suggests that the company has been experiencing negative operating cash flow, with a significant deficit of $15,780,294 in net cash provided by operating activities. While there is one instance where the company generated a small amount of positive operating cash flow in 2024, this is described as an isolated occurrence and not indicative of the long-term trend. Therefore, it can be concluded that the company's overall performance has been characterized by negative operating cash flow. The company's debt level has experienced significant changes over the past year. Initially, the total debt increased by $5,940,000 with the additional note, bringing the initial total debt to $4,050,000. This was followed by a further increase of $6,701,887 from December 31, 2024 to December 31, 2025. The interest expenses have also seen substantial changes. The interest expense increased by $20,304,237, 432.44%, due to the original issuance discount and one-time 10% interest charge on notes. Furthermore, in 2025, non-cash interest expenses reached $17.4 million, a significant increase from the $4.8 million recorded in 2024. The data suggests that both debt level and interest expenses have undergone substantial changes over the past year. The increases in debt level and interest expenses indicate a potential financial strain on the company. The performance of various regions and segments in the industry has been mixed. In terms of regions, Colorado's DJ Basin, Central Oklahoma's Stack Play, and the Permian and Eagle Ford basins of Texas have performed well. On the other hand, remediation services and RPCs have struggled. Looking at the segments, crude oil transportation and terminaling and storage facilities have been strong performers. The transportation and logistics segment has also done well. However, the supply and trading segment has contributed significantly to total revenues but generated minimal gross profit. In contrast, crude oil transportation, terminaling and storage, and marketing and trading activities have performed poorly. Management's outlook for the company is optimistic, with a focus on revenue growth and profitability. The company plans to expand its service offerings through the introduction of remediation services in 2026, which will support domestic waste treatment and recycling initiatives. This expansion is expected to reduce environmental impact and promote responsible resource management. The Remediation Processing Center, set to begin operations in 2026, will process up to 800 tons per day of oilfield waste. Management aims to leverage the company's integrated network and pursue selective acquisitions and organic development to increase utilization, improve margins, and strengthen its competitive position. However, management is also aware of potential risks and challenges, including stricter environmental regulations and increased fines for noncompliance, which could impact the company's business. Additionally, a lack of capital may force the company to modify its business plan or curtail operations, potentially delaying product development or commercialization efforts. To mitigate these risks, management is actively pursuing multiple initiatives to enhance liquidity, including raising capital through equity and debt financings, executing a structured financing arrangement, and advancing the potential sale of certain midstream and transportation assets. The company's ability to issue additional securities for financing may be affected if its common stock is not traded on a national exchange. Overall, management strategy focuses on deepening integration, expanding terminaling connectivity, environmental expansion, selective acquisitions, and asset optimization, while identifying, developing, and acquiring complementary assets and services to enhance the integrated midstream platform. The company has a history of paying dividends to its shareholders. According to the extracted summaries, the company's preferred stock has a cumulative 6% annual dividend per share payable quarterly in arrears in shares of common stock. This indicates that the company has been consistently paying out dividends to its preferred shareholders. In addition to the mandatory dividend payments, the company also voluntarily suspended dividend payments from August 1, 2025 to January 1, 2026. However, this suspension was a deliberate decision made by Mr. Balanji and certain affiliates, suggesting that the company's financial situation allowed for such a move. On the other hand, the company has only recently engaged in share buybacks. According to the summaries, the company issued 11,058 shares of preferred stock in exchange for $11,058,235 USD as part of the water trucking sale. This transaction can be seen as a form of share buyback, where the company acquired its own shares using cash from the sale. Overall, while the company has been paying dividends to its shareholders, it has only recently engaged in share buybacks through the issuance of new preferred stock. Supply chain disruption concerns. The extracted summaries reveal several concerns regarding supply chain disruption in the energy industry. One potential issue is the impact of prolonged low oil prices on drilling and production, which could lead to reduced or delayed operations, page 14. Additionally, geographic concentration in specific basins may cause regional supply and demand fluctuations, as well as transportation or processing constraints that can disrupt the supply chain, page 15. Transportation logistics issues are also a concern, with one source indicating yes to this issue, page 21. Furthermore, conflict in Iran has disrupted regional energy markets, critical infrastructure, and maritime supply chains, posing a significant threat to the stability of global supply chains, page 23. The company is taking proactive measures to mitigate potential disruptions by investing in remediation processing centers, RPCS, page 35, which suggests an effort to minimize the impact of supply chain disruptions. Another example of this concern is seen in the water trucking sale, where assets and liabilities were transferred between affiliates to minimize operational disruption, page 63. That concludes the financial summary for Vivakor Inc. Feel free to comment below, and I will be happy to answer them when possible.